Hi everybody. So our topic today is stock valuation. I've discovered this is a topic that most people have quite a bit of natural interest in. Let's dive right in and see what we can learn. You know that at this point I like to begin all of our discussions by talking about where this topic sort of fits into the overall narrative of our course this semester. We all remember at this point finance is the optimal allocation of scarce financial resources, which includes procurement, deployment, and distribution of financial capital. We further break down deployment into operational efficiency, asset purchases and sales, and go, no-go decisions. We've said all that we're going to say about operational efficiency. That was financial statement analysis and ratio analysis in chapters 2 and 3. We began a discussion on the subject of asset purchases and sales when we started talking about bonds in our previous lecture. I hope I mentioned that one of the reasons we love to start with bonds when it comes to asset purchases and sales is because estimating the right price for a bond is a very straightforward process. Once you have just a little bit of economic intuition and some time value of money skills in your tool belts, it's pretty easy to execute bond pricing, and that's why we like to start there. Today, we move into a more difficult subject that has a lot more uncertainty, a lot more ambiguity, and that is estimating the right price of stocks. So we're still in the second category of asset deployment or financial resource deployment, and that second category is asset purchases and sales. The go, no-go decision, the third method by which, or the third type of deployment of financial resources, we cover that in Chapter 9 with a subject that we call capital budgeting. I want to give a little bit of perspective on this second category of optimal deployment of financial resources, and I want to talk about what we mean when we say buying and selling assets. Generally speaking, what I'm referring to and what I intend to refer to, even if I don't say it over the rest of this lecture, is the idea, nay, the axiom of buying low and selling high. And we need to talk about that for just a second. What I mean is we want to talk about a strategy in which you deploy financial resources by either buying assets at a discount and or selling those assets when they reach some sort of premium, reasonable or not, in the market. So the translation is, if you could do this, if you could identify assets when they are underpriced in the market and buy them at that point, and it doesn't have to be both, it could be one or the other, and or if you could sell them when you realize that the market price is overvalued, this strategy will generate what we call abnormal risk-adjusted returns. All we mean to say when we refer to abnormal risk-adjusted returns is if you take the returns that you're creating in your portfolio of assets and you divide it by some measure of risk, and most people start with a very basic measure of risk, which is the standard deviation of the returns. In other words, how much volatility did you experience in the returns to your portfolio? So just as a very simple example, in my stock portfolio, maybe in any given year, I earn 8%, but over the course of that year, I may have been up by as much as 12 and down by as much as -4. So there is volatility in any given year. We often use the volatility as a proxy for risk. So if I took the return to my portfolio and I divided it by sort of the volatility, the risk that I had to endure during the year, think about that ratio of return to risk or return to volatility. Think of that as a measure of what we would call sort of risk-adjusted returns. And I should add, there is a whole broad field of the right way to do risk adjustment. I'm just trying to sort of wave my hands at it to help you understand my perspective of today's topic. But imagine that. Imagine that you have returns divided by the volatility. This ratio would tell you what your return was for every unit of risk that you took. See, we understand that return over the long run should be correlated with risk. So one way that you can get high returns over the long run is to just take a lot of risk. But what we want to talk about today is the idea of deploying financial resources in a way such that you optimize the amount of return you get for every unit of risk. And so what I'm trying to say is, if you could buy assets when they were undervalued in the market and then turn around and sell them when they're overvalued in the market, that should be a strategy that gives you abnormally high risk-adjusted returns, meaning your return for every unit of risk that you take should beat the market average, and that's what we're talking about here. If that's what we're referring to, then there are three necessary conditions in order to be able to execute a strategy of this sort. The first necessary condition is there would have to be occasional mispricing. In order to either buy low or sell high, the market price has to occasionally get low or get high, meaning it has to get undervalued or overvalued. The second necessary condition is there must be tools that exist that would allow you to identify when that asset is either underpriced or overpriced. The third condition is there must be the realistic expectation that the prevailing market price will eventually converge to where it should be. Imagine there's an asset and it does get mispriced, so it's undervalued out in the marketplace. So condition number one is met. Condition number two, imagine that you have a tool that gives you a signal and tells you that this asset is undervalued. So you go out and buy it. Well, without condition number three, there is no guarantee that this is going to be a profitable strategy. Just because you can identify an asset that's underpriced and you can go and buy it, that doesn't guarantee you abnormal profits unless you have some realistic assurance that the market price will eventually converge to where it should be. So these are the three necessary conditions. This, by the way, this is different. This paradigm is different than, say, buy and hold investors who simply sit down and say, I have a certain amount of risk tolerance. I'm going to construct a portfolio that is within the parameters such that I'm going to be comfortable with the risk in that portfolio based on my risk tolerance, and then I'm just going to be happy with whatever return that portfolio generates, knowing the risk level that I've put into it. That's different. Again, what we're talking about is buying low, selling high, trying to generate returns that on a risk-adjusted basis would be higher than average. Well, what we really want to talk about today is that second necessary condition. What are the tools right here that could help us identify mispricing in the market? Oftentimes, what we're going to do is we're going to estimate what we call the intrinsic or the fundamental value. So we're going to use models to try to estimate what we think the value of any given asset should be. And once we come up with our intrinsic or fundamental value, we will compare that to the prevailing market price. If our intrinsic value is above the market price, this is a moment when we think that an asset is undervalued and we should buy it. If our intrinsic value is below the prevailing market price, that's a moment where we would infer that the market has overvalued the asset and we would look to sell. So we're trying to come up with tools to allow us to estimate intrinsic or fundamental value. So let's start by just reminding ourselves of some basics that we've learned in previous discussions. We know that stocks are financial assets, and the hallmark characteristic of financial assets is that financial assets only offer future cash flows. There are no other utilities or benefits to be had from owning a financial asset. If that's the case, if the only benefit is future cash flows, then we have decided that the intrinsic value or the price of a financial asset should simply be the sum of the present value of the expected future cash flows. And I've put here on the screen the shorthand mathematical notation for that intuition. So in every period, starting in period 1, going to the terminal period, we would simply map out the cash flows, and then we would find the present value of each of those cash flows using our fundamental time value of money formula, right? Our keystone, cornerstone, seerstone formula. Do that for each of the cash flows, add up those present values, and that should give you the price of the financial asset. But remember, we also talked about how there are certain questions that we're going to have to address if we're going to execute this theoretical model for determining the price or the intrinsic value of a financial asset. So what are the questions? And by the way, it gets a little more challenging as we move from bonds to stocks. What are the questions that we're going to have to think about and deal with if we want to execute this intuition mathematically? Well, first off, what are the right cash flows to use? Remember, with bonds, it was pretty straightforward. It was just it was the principal and it was the interest. With stocks, it gets a little bit more ambiguous. So what are the right cash flows to use? And we're going to talk about models that use different types of cash flows. The second question is, how do we forecast those cash flows? Well, we've already sort of talked about how you can forecast one type of cash flow. We will later on in the lecture talk about the discounted cash flows model, which uses free cash flows to the firm as the answer to that first question of what cash flows should we use. We've talked about how you would forecast free cash flows to the firm. You would use percentage of sales forecasting to map out the income statement and the balance sheet. Once you have the income statement and the balance sheet, you should be able to calculate free cash flows to the firm. The third question, how to deal with an infinite horizon. So this is one of the new questions that arises as we move from bonds into the world of stocks. Bonds were really convenient in the sense that bonds typically have a clear end date. There is a maturity date, which makes it so that the math is finite, which helps us. When we move into the world of stocks, it's conceivable that the cash flows turn into perpetuities. We hope and expect that companies will be going concerns, and if they are going concerns over extended periods of time, then there is no clear end date. There is no maturity date for stocks. So we're going to have to think about how to deal with infinite horizons. The fourth question is, how do we account for time? Thankfully, we've already answered that question. We're going to take the present value of any cash flows that we forecast using that fundamental time value of money formula. The last question is, how do we account for risk? We haven't really done a deep dive on this topic. We have sort of alluded to how we're going to deal with risk. The short answer is our discount rate in our equation over here, R in the denominator, needs to fully capture the risk of the cash flows. So that's the short answer. Again, we're going to do a deep dive on that in our last lecture of the year. Well, what are some of the possibilities then if we're going to execute valuation models to try to estimate the intrinsic value of stocks with the intent of comparing that to the market price so that we can try to buy low and sell high? Well, there are four obvious candidates. There's something called the method of comparables. There's a dividend discount model. There's something called the discounted cash flows model and something called the residual earnings model, and there are many others. In fact, I thought it might be interesting just to show you this website called Kcm Analytics.com. So when you come to Kcm Analytics, what this is a website that attempts to execute a multitude of valuation models for most of the stocks trading, or at least the blue chip stocks that are trading in the US right now, and for actually quite a few of the smaller stocks as well. So for instance, you can put a ticker symbol in here. We could put in, let's do McDonald's. And you can see what happens is here at Kcm Analytics, a number pops up, 113.91. That is the best estimate, the best guess of Kcm Analytics using all of its valuation models. And you can see that they use dividend-based models, sales-based models, earnings-based models, book value-based models, cash flow-based models. They also go and look at analyst estimates. So what they're doing is they're employing a host of models to try to triangulate what they think is the best guess of the intrinsic value of this stock. Now, if I had an account and I logged in, and I used to have one, but I don't right now, if you logged in, you could actually click on each of these categories and expand it, and you can see that under each of these categories there are multiple models. So there are a variety of models that exist out there that try to help you create an intrinsic value. It might also be interesting for you to see that this is the name of the game for financial analysts on Wall Street. We call these people sell-side analysts. So for instance, if I come to Yahoo Finance and I pull up McDonald's here, I can scroll down to analyst opinions, and you can see that for McDonald's, there are 21 brokers, which means there are 21 different brokerage houses that employ sell-side analysts, and the job of the sell-side analyst is to estimate the intrinsic value, like Kcm Analytics, come up with an intrinsic value, and then estimate a target price. The target price is what the analyst thinks the stock price will hit in the next year. So if we look at McDonald's, we can see that the average target price for the 21 sell-side analysts is $126. The highest is $138, the lowest is $106. That's actually a pretty wide range. And then these sell-side equity analysts who estimate the intrinsic value to estimate a target price, the next step is they make a buy or sell recommendation. You can see Yahoo tries to aggregate this using a numeric scale, 1 representing strong buy, 5 representing sell. You can see McDonald's is at a 2.3, which means it's sort of neutral, slightly leaning towards buy. And then down here, this is kind of fun. They show you the changes. So for instance, Piper Jaffray on October 23rd, 2015, changed it from a neutral to an overweight, which is their way of saying we're moving from a neutral position to a moderate buy recommendation. Argus just recently went from a hold to a buy recommendation. Now, a couple of observations about analysts. We know from the academic literature that analysts tend to herd, which means if 20 other analysts are saying buy, the 21st analyst tends to say buy as well. This is job preservation. If you run with the herd, you won't get crucified if reality goes in a different direction. What I mean to say there is if 20 analysts say buy and you're the lone wolf analyst that says sell, and then McDonald's has a great year, you're going to get crucified by the market for being wrong. If, however, 20 analysts say buy and you jump in with the herd and you say buy, and then McDonald's has a tough year, people are going to be very forgiving because you can look around and say, well, hold on a second, I wasn't the only one that thought this. So there's very strong herding amongst sell-side analysts. We also know from the academic literature that analysts are excessively optimistic. There are numerous theories as to why this might be. The one that I think has the most traction and credibility for me is all of these sell-side analysts are employed, generally speaking, by large investment banks, such as, and you can see down here, Deutsche Bank, Credit Suisse. So if I'm a sell-side analyst for a large investment bank, there's pretty strong incentive for my investment bank to say positive things about publicly traded companies because I want them to come to me when they need to float a bond. I want them to come to me when they need to do a seasoned equity offering. So I want to say favorable things about these companies so that I can generate business from them down the road. Now, if you go and talk to an investment bank, they would say that's hogwash. They would say there are Chinese walls, there are firewalls between the analysts and the rest of the company. In fact, some of the investment banks even have literal walls separating their analysts, their sell-side equity analysts from the rest of the company. I don't doubt that. So I know that there are real and metaphorical firewalls inside of the investment banks. Nevertheless, I think there is still some unspoken pressure for the analysts to give pretty favorable recommendations for the stocks that they cover. Okay, so I'm getting us a little bit far away from what I want to talk about today. I'm just trying to motivate it for us. But I want to show you all I'm going to do is talk about 3 of the models. I'm going to talk about method of comparables, the dividend models, and the free cash flows models. I'm not going to talk about the residual earnings model, but I am going to put it out there in case you wanted to go learn about it on your own. But I just wanted to show you Kcm Analytics to expose you to how many models are out there. And then I wanted you to see Finance Yahoo so that you would realize that there's a whole industry around the topic that we're covering today, which is estimating intrinsic or fundamental values. Specifically, this is largely the purview in the space of what we call sell-side equity analysts. So let's dive right into the method of comparables. The method of comparables is actually the simplest of all of the models to execute, and the method of comparables doesn't even really try to execute the intuition that we talked about earlier, right? We said that the value of a stock should be the sum of the present value of the expected future cash flows. The method of comparables throws its hands up from the outset and says that sounds way too complex. We're not going to try to forecast anything. We're not going to take the present value of anything. We're simply going to use the prevailing market data on competitors to infer the intrinsic value for the target company. I want to walk you through what it looks like, and I think as we walk through it, and especially as I show you an example, it'll start to really make sense to you. Looks like there's a lot of steps. There aren't. It's a very simple, very straightforward valuation model. I might also throw in here parenthetically, research suggests that this is the most widely used of all the stock valuation models that I'm going to show you, probably because it's the simplest. So here's the first step under the method of comparables. Simply identify the target firm for your valuation. So what company are you trying to estimate the intrinsic value for? The second step is identify the closest competitors, and we're going to call these the comparables. Now, in this second step, you're trying to strike a balance. In a perfect world, you would find an exact carbon copy, a clone, right? In the world of medical research, the gold standard for medical research is to take identical twins separated at birth. We think that's a great way to do scientific research because the benchmarks are perfect, right? They're perfect matched samples. So in a perfect world, when you're doing the method of comparables and you're looking for comparables, you would be able to find that identical twin separated at birth from your target company. Well, but the trade-off is you also want to have a sample of comparable firms. You don't want to rely on just one or two comparable firms. So in step number 2, you're searching for this balance, this trade-off between companies that are truly comparables, companies that somehow approximate identical twins to your target firm, versus the idea that you want to have as many comparables as possible to give you statistical power in what you're trying to accomplish. Well, once you've identified what you think are reasonable comparables, the next step is you need to figure out what you're going to use as your proxy variable for firm intrinsic value. What I mean by that is some variable that you can observe that you believe is closely correlated with fundamental value. For a lot of people, it's earnings. A lot of analysts believe that companies procure capital to obtain assets to create a product or service that generates sales, that translates into profits, that then can be redistributed to the shareholders. So for a lot of analysts, earnings are the most obvious proxy variable for fundamental value. It doesn't have to be earnings. Some analysts use sales. Some analysts use cash flows. Some analysts use the book value of assets. What you use as your proxy variable for firm value or for fundamental value very much depends on the industry you're analyzing and the target firm that's under your microscope. But I would say, generally speaking, the default proxy variable is earnings. The next step, step 4, is to calculate the market value per dollar of proxy variable for each comp. That's much simpler than how it sounds. So for every comparable firm, you just go take their market price and divide it by your proxy variable. So if it's earnings, maybe you're using EPS, then you just go and take the market price of the comparable divided by EPS. Now that's a ratio that should ring a bell for most of us. That is called the PE ratio, the price to earnings ratio. So that's step 4. Figure out how much market value exists for every dollar of the proxy variable. So for instance, what if you do this for a comp and it returns a PE ratio of $11? The interpretation would be for every $1 of EPS that this company generates, the market rewards them with $11 of firm value. The next step then, once you have that, is to determine the average market value per dollar of proxy variable for all comps. So continuing our discussion, if we're using EPS as the proxy for firm value, then in step 4, you calculated the PE ratio for all of the competitors. In step 5, you're going to determine the average PE ratio. So maybe when you do this for your target firm, you determine that the average PE ratio for all of the competitors is 12. And what that means is that for every dollar of EPS generated by this group of firms, on average they are rewarded with $12 of market value or price. The last step then is to take that average ratio, so in our example the average PE ratio of 12, and multiply that by the proxy variable for the target firm. So if you discovered that the average PE ratio in your industry is 12 or amongst the competitors, then you know that for every $1 of EPS that a firm generates, on average the market gives it $12 of market value. If you now then go to your target firm and they have EPS of $3, then you can back into the intrinsic value for the target firm. Because they generate $3 of EPS, you know that on average the market gives you $12 of market value for every dollar of EPS. So you simply take the average PE ratio of 12 and multiply that by the $3 EPS for the target firm, and you would get an intrinsic value of $36 for the target company. So let me try to give you an example of this. So here we are doing the method of comparables. I've decided that my target firm is American Eagle, and I'm trying to walk us through this step by step. So step 1 is to identify my target firm, which I've done. It's American Eagle. Step 2 is to identify the closest competitors. Now, I must confess, I would never proclaim to be an expert in the retail fashion industry, so some of these competitors may not be very, very close competitors. Remember, what we're looking for is a trade-off. Ideally, we would like the identical twins separated at birth, but we also want to get as many as possible to create statistical power. I've settled on 5 competitors: Abercrombie & Fitch, The Buckle, Express Inc., Gap, and Land's End. So these are my 5 comps. Step number 3 is to decide on a proxy variable for intrinsic value. Like I was saying earlier, most analysts believe that the closest proxy variable for firm value is earnings. I'm going to use EPS as my proxy variable then. But again, it doesn't have to be, and there are situations where it can't be. For instance, imagine you are trying to value a startup, a tech company out in Silicon Valley that's just getting launched. A company like that typically doesn't have earnings, so you couldn't use earnings as the proxy for firm value in that situation. You would have to look at something else. You might look at sales. You might look at traffic on their website. So you just use the best, most reasonable proxy variable you can come up with. In other words, the variable that you can empirically observe that you think correlates closely with fundamental or firm value. For us, we're going to use EPS. Okay, the next step is to calculate the market value per dollar of proxy variable. Now, when we say market value, we just mean prevailing market price. So what I've done is for each of the competitors, I've gone out and I've recorded what the prevailing market price is. I've also recorded the proxy variable, which is EPS, and this is the trailing 12-month EPS for those of you who are a little bit more advanced. So for Abercrombie & Fitch, they had EPS of 32 cents. The Buckle was at $3.18. Express was at $1.21. Gap was at $2.44. And Land's End was at $1.66. What I want to do then is calculate the ratio, and what we're trying to figure out is how much market price, how much market value does the market give these companies for every dollar of EPS. So I go ahead and calculate the PE ratio, and here's what I get. For Abercrombie & Fitch, I get 77.41. For The Buckle, I get 9.19. For Express, I get 13.36. For The Gap, I get 9.73. And for Land's End, I get 13.28. Okay, so that is step number 4. Now, we should pause right here. There's an important point to be made. At this step, you should start playing that old Sesame Street game that we all remember. Which one of these things is not like the other? And I immediately realize that Abercrombie & Fitch has an astronomically high PE ratio, while the rest of them look like they're sort of in the same zone. That tells me that I'm probably going to want to get rid of Abercrombie & Fitch as I move forward. So I am going to do that when I move into the next step. That next step, by the way, number 5, is to determine the average market value per dollar of proxy variable for the competitors. That's a mouthful. All we're doing is taking the average PE for all the competitors. So if we take the average turns out to be 24.59. However, I want to get rid of Abercrombie & Fitch, and you can see when I get rid of Abercrombie & Fitch, that turns the average into 11.39. I think it's valuable for us if we stop right here and talk about what that means. So on average, for these 4 comparable firms to American Eagle, which is our target firm, on average for every $1 of EPS that they generate, the market rewards them with $11.39 of market value or market price. So the last step is to simply multiply that average by the EPS generated by American Eagle. And in the most recent year, they had $1.01 of EPS. So I simply multiply that by 11.39, and I get an implied intrinsic value of $11.50. Okay, so method of comparables, what do we like about it? It's very simple to execute, even though I'm showing you 6 steps. Really, the intuition and the execution is very straightforward. You can do this on the back of an envelope. We also like that there's no forecasting required. Now, why do we like that there's no forecasting? It's simply because forecasting is a treacherous activity. Anytime you begin to forecast, you're going to make mistakes. It's inevitable. So we appreciate that the method of comparables is not trying to do that. What worries us, however, though, when it comes to the method of comparables? Well, first and foremost, we're very concerned about the possibility of finding true comparables. This model becomes more reliable the more closely your competitors align with your target firm. If there starts to be disparity and heterogeneity between your target firm and the competitors, then this model starts to lose credibility. So just as an example, I might throw it out there, who would you identify as the comparables for Google? And you might come up with a couple of companies that compete in a few revenue lines, but really we would all agree that there is no true competitor or comparable to Google. Another problem with this model is negative denominators. So what we said is over here, we used earnings as our proxy for firm value. You will find some comparables that have losses. They'll have a negative EPS. You must be supremely cautious. If you have a negative denominator, you have to throw out the observation. Choosing the right proxy can be challenging. What observable variable is the most highly correlated with the fundamental value? In some sense, that's an empirical question. You could try to get data on that. What I mean is you could say, well, maybe it's earnings, maybe it's operating cash flows, maybe it's free cash flows, maybe it's sales. Whatever you pick, you could actually go and get historical data and look at correlations, but still it is a little bit arbitrary and a little bit challenging to figure out which proxy variable is right. Lastly, there are what I call market efficiency questions. The method of comparables inherently assumes that the market price for the comparables is pretty accurate. In other words, this method absolutely assumes that the prevailing market price is a reasonable approximation of the fundamental value. And then you're going to use those prices of the comps as approximations of fundamental value to estimate the fundamental value for your target firm, and then you're going to use that fundamental value to go and challenge the market price for your target firm. So the model asserts that the market prices are pretty efficient, they're pretty close to the fundamental value for the comps, but not for the target firm. But it's entirely possible that it's the other way around. It's entirely possible that in reality, the market price for your target firm is more efficient, it's closer to the fundamental value than are the market prices of the comparables. So that's why I just bring up there are market efficiency questions. Maybe you shouldn't be using the market price and EPS of the gap to try to estimate the fundamental value of American Eagle. Maybe you should be using the market price and the EPS of American Eagle to try to estimate the fundamental value of the gap. So just some market efficiency questions. One other just point of nuance I would like to talk about here. So when we did our analysis, we threw out Abercrombie and Fitch. That was kind of obvious. But I also want you to notice there is still variance in the PE ratios across the 4 competitors. The Buckle's at 9.19, Gap is at 9.73, Express and Lands' End are both at 13. There's starting to be a bimodal distribution. 2 of these comps have a PE ratio of 9, 2 of them have a PE ratio of 13. We're sort of using a caveman approach and just taking the average of 11.39. But there's a really burning question that comes up, and the question is, what is driving the difference in these PE ratios? And there are 2 obvious suspects here. One obvious suspect is expectations about growth prospects, and I want to come back and try to explain this to you. Even though we're not using this intuition right now, we still believe that it is good, solid, sound intuition to say that the price of a stock should be the sum of the present value of the expected future cash flows. So this, theoretically, should be the price of a stock. So what could lead to a very high price to earnings ratio would be, number one, if the projected cash flows in the future are growing at a very steep rate. That would give you a high price relative to current earnings. So maybe the reason that Express and Land's End have higher PE ratios is because the growth prospects are better for those firms. The second candidate is it could be because the R is low. Remember, the R is the discount rate. It's supposed to capture the risk of the future cash flows. So another way that you could get a higher PE ratio is if the analysts believe that the riskiness of the cash flows for Land's End and for Express are lower. If the risk is lower, R will be lower, and that will increase the price. So this could have higher growth or lower risk, those two companies. Well, the question we've got to ask ourselves is, should we just use this naive approach of averaging all four of these PE ratios, or should we take the time and expend the effort to figure out where we think American Eagle falls? Do we think American Eagle has higher growth and lower risk? Do we think it's more like Express and Land's End? If so, the intrinsic value is going to be very different. If we think that those are the right competitors, then the intrinsic value should be $13, not $11. If, however, we conclude that American Eagle is truly more of a low growth or higher risk company, then we might want to use Gap and Buckle as the competitors, and in that case, the intrinsic value would only be $9.55. So depending on how we feel about American Eagle relative to their competitors, and depending on what we believe is driving that difference in PE ratios, we could get an intrinsic value all the way from $9.55 up to $13. So I think that's an important little point for us to understand. All right, well, that's all I want to say about method of comparables. Very simple, very straightforward model. It's sort of a first pass back of the envelope model. There are some things to worry about. When does the method of comparables make the most sense? I see it most reasonably applied when private firms have public comps. So if you're a VC or a PE shop and you're trying to value a private firm, or if there's a company that's private that's thinking about going public, so you're an investment bank trying to come up with an initial valuation, then I think this model makes a ton of sense. But again, I want to repeat, this is the most widely used model. Well, let's move forward into the second set of models. The second set of models are dividend-based models, and the intuition is very straightforward. Stocks are financial assets. Therefore, the value, the intrinsic value, should be the sum of the present value of the expected future cash flows. And further, dividends are the most obvious cash flows that go to shareholders from a stock. So let's just map out the cash flows, map out the dividends, that is, and discount them back, and that should give us the value of the stock. Well, there are three sort of types of dividend discount models. They're very simple. The first one is what we call the constant or no growth dividend discount model. This is where we assume that the dividends will remain constant indefinitely. And if that's the case, estimating the price of the stock is very straightforward. I would just like to remind you that when we studied the time value of money, we learn how to calculate the present value of a perpetuity. You simply take the next cash flow and divide it by the difference between the discount rate and the growth rate. But if there is no growth rate, that formula reduces to simply the last cash flow, because they're not growing, so you don't even need to worry about the next cash flow. So the formula simply reduces to the last cash flow divided by the discount rate. So if you have a stock that pays a constant dividend, based on this formula for the present value of a perpetuity, you could estimate the fundamental value by simply taking the last dividend and dividing it by the discount rate. So that is the very basic, very straightforward, constant, no growth dividend discount model. Well, you might guess that the next step up from this is to simply assume that there is a constant growth rate. So if we assume a constant growth rate, and we call this the constant growth dividend discount model, then we can simply directly apply this formula that we've reminded ourselves of, that the present value of any perpetuity is simply the next period cash flow divided by the difference between the discount rate and the growth rate. So to value a stock that pays a constantly growing dividend, we would simply take the next dividend divided by the difference between what we think the discount rate is and the constant growth rate in the dividend. And I'll give you an example here in just a couple seconds. Okay, so this moves us to the last type of dividend discount model that I want to cover, and this is called the two-stage dividend discount model. And in order to understand this, I want you to imagine a stock that is not quite to the steady state phase of its life cycle. So it's still got a little bit of growth left in it. However, we can sort of see steady state cash cow phase out on the horizon. It's not too far away. How would we think about valuing this stock using a dividend-based model? Well, we're simply going to use the intuition of mapping out the cash flows and discounting the back, but what it means is there's going to be two stages in the growth of the dividends. During this initial stage where they have not quite yet hit that cash cow steady state phase, there's going to be a variable growth rate in dividends. So maybe the growth rate is 8% right now, and it's sort of slowing, but it's going to be changing. So there's a changing growth rate. So if that's the case, we cannot naively just implement the formula for the present value of a perpetuity, because that formula for the present value of a perpetuity assumes constant growth, and yet we don't have constant growth here. So here's how we attack that problem. During the growth phase, which is the first stage up to the red dotted line, and I'm going to use capital T to represent the period after which dividends hit a steady state growth rate and the firm just becomes a cash cow. Up to that point, up to the end of period T, we're going to have a variable growth rate. So we're going to have to take the time to go in and individually forecast those dividends. So we're going to have to forecast the dividends during the first few years until we hit that steady state. And then, and this isn't new, we're just going to use that cornerstone, keystone, seerstone, fundamental time value of money formula to find the present value of those. So that should be easy peasy lemon squeezy. But now, once we hit here, this dotted line represents the end of period T. Imagine that you could walk forward in time and stand right there at the end of period T. What you would see looking forward is a constantly growing stream of dividends in perpetuity. And if you were standing, and this is super critical, if you were standing at the end of period T, you could calculate the present value of that stream of cash flows because you know how to calculate the present value of a perpetuity. But remember, you can't do that at time zero. Because at time zero, when you look forward, you don't see constant growth in the dividends. You only see the constant growth in the dividends once you get to the end of period T. So imagine we're standing at the end of period T, we look out, we see a stream of constantly growing dividends. Well, we can calculate the present value of that using the formula for the present value of a perpetuity by taking the cash flow in the next period, which in this case is dividend in period T plus 1, the period after the terminal period, and dividing that by the discount rate minus the growth rate. What have you done there? You've calculated the present value of all of the dividends after the end of period T as if you were standing at the end of period T. So you need to do something to that value. By the way, we call that the terminal value. You need to do something to that terminal value since it represents the present value of all the rest of the dividends as if you're standing at the end of period T. You need to discount it back T periods. So you need to divide that by 1 plus the discount rate raised to the capital T. So if you do that, you'll just be finding the present value of the terminal value as of period 0. Once you do that, you just add up all of those present values and you have your estimate of intrinsic value. So let me give you some examples of the dividend discount model. So here's an example of the constant or no growth dividend discount model. So I'm doing this for Tootsie Roll. I'm assuming that they paid their last dividend of 36 cents. We're not projecting any growth, which means the next dividend payment is also going to be 36 cents. I'm assuming a discount rate of 7.5%. All we would do is take that last dividend and divide it by the discount rate, and it gets us an intrinsic value of $4.80. Let's now entertain the idea of constant growth. So I'm doing this for Hershey's. Hershey's last dividend payment was $2.32. What if we believe that that's going to grow at a constant rate of 4.75% into the indefinite future? Then we would simply use the present value of a perpetuity formula to estimate the value of the stock. So if that's the last dividend, $2.32, we would simply grow that. So multiply it by 1 plus our growth rate. And that gives us $2.43. So that's our best guess of the next dividend to be paid. Then if the discount rate is 7.5%, to find the price of the stock or the intrinsic value of the stock, we would simply take the next cash flow and divide it by the difference between our discount rate and our growth rate. And we can see that we get $88.37. So that's the constant growth dividend discount model. All right, two-stage dividend discount model. Again, I'm back to Hershey's. We said that their last dividend payment was $2.32. Now what I'm going to do is I'm going to entertain the idea that their dividends might grow at variable rates over the next 5 to 10 years, but then after that they'll fall into a steady state. So here's what I'm going to say. What if I believe that their growth rate next year in their dividends will be 10%? But after 5 years they're going to hit steady state, and at that point the growth in their dividends will simply be 4%. So what I've done over here, I've said, okay, let's assume a 10% growth rate in dividends in the first year. By the time they get to the 6th year, because now we're past 5 years, they reach a steady state growth rate. So then what I've decided to do is I'm just going to sort of monotonically ratchet down the growth in dividends each year until I hit steady state. Now, you don't have to do that. You could go in and put your own manually, subjectively forecasted growth rates, but I just used this method. So I started at 10 and ratcheted it down. So then what I did is I forecasted my dividends. So how did I get $2.55? I just take the last dividend of $2.32 and I grow it at 10%. How do I get $2.78? Well, I take the dividend of $2.55 in period 1 and I grow it at 8.8%. So I just forecast all the dividends. The next step is to just use my cornerstone, keystone, seerstone formula and find the present value, which you can see I've done right here. Right, I just take my dividend in D6, I divide it by 1 plus my discount rate over here in I9, and I raise that to the number of periods over here in B6. I do that for all of the 5 dividends through those first 5 years. I don't do it for the 6th year, because remember what we're saying is once we hit steady state, which is 5 years, then we hit steady state, and now at the end of the 5th year we can calculate the present value of the constantly growing perpetuity. So over here, 5th year is when we hit steady state. So we only need the 6th year dividend to calculate the present value of the rest of the dividends as if we're standing at the end of year 5. So we're going to take the dividend in year 6, which is period T plus 1. We're going to take that and we're going to divide it by the difference between 7.5% and 4%, and that will give us the terminal value, $99.37. Once we have that, we still need to discount that back 5 years. So I do that by simply dividing it by 1 plus the discount rate raised to 5 years. And that gets me $69.22. Then all I do at this point is add up all of the present values of the first 5 years and the present value of the terminal value, and it gives me an intrinsic value of $81.11. Okay, so what do we like about the dividend discount model? Well, what we love about it is it's based on really good theory. We believe it's not up for debate. This is truth. The right way to value a financial asset is to take the sum of the present value of the expected future cash flows. The dividend discount model is trying to do exactly that. It's trying to forecast cash flows discount them back. It's dealing with the infinite forecasting horizon. It's taking into account the time value of money by finding the present value, and it's accounting for risk, which is captured in the discount rate. So, in other words, it really is based on good theory. However, there are several things that bother us and worry us about the dividend discount model. First off, many firms pay low or no dividends. Google's the prime example of this. They said in their S1, which is the document you file when you're going public, they said, we do not pay dividends. We do not ever plan to pay dividends. According to the dividend discount model, if that's the case, if there are no dividends, then the intrinsic value of the firm is going to be $0. Well, how many of us buy the notion that the true value, the intrinsic value of Google should be 0? Nobody buys that. Second problem, dividends can be manipulated in the short run. Dividends are a decision by managers. They decide how much they're going to pay out in the form of dividends, which means they can be manipulated, which means our model can be manipulated, which leads us to the third problem. Since they are a choice by management, dividends are not really reflective of value added. Dividends are reflective of the portion of value added that management wants to distribute. That's what they represent. So in other words, we don't really think that a dividend discount model is based on a cash flow that's representative of true value created by the company. Having said that, and even though there are problems with the dividend discount model, it does make sense in some situations. When does it make the most sense? Well, if you have a company that pays a steady, reliable dividend, or a dividend that's been growing at a reliable rate, then the dividend discount model makes a lot of sense. So specifically for utilities and especially for preferred stock, this is a great way to value those entities. All right, so let's go into our last model here. The last model we want to think about is the discounted cash flows model. We've already said stocks are financial assets. That means the price should be the sum of the present value of expected future cash flows. We're all good with that. We said the dividend discount model tries to operationalize this. The discounted cash flows model basically views the dividend discount model as its little brother, and the discounted cash flows model like pats the dividend discount model on the head and says, nice try. Like you gave it a good, really good, valiant effort, but you made one big mistake. And that big mistake is you simply used the wrong cash flows. The discounted cash flows model says you shouldn't use dividends. Instead, you should use free cash flows to the firm. And here's why. So let's have a brief conversation about cash flows. Let's think about dividends relative to free cash flows and how they're different. So we know that dividends only go to shareholders, whereas free cash flows are paid to both shareholders and creditors. We've already said that dividends are a choice by management. They are paid at the discretion of management. Free cash flows, however, involve much less choice. For that reason, dividends can be manipulated in the short run since they are at the discretion of management. But since free cash flows to the firm involve far fewer choices on the part of management, they're much more difficult to manipulate. And because of that, we don't believe that dividends are a reliable measure of value creation, but we think that free cash flows are a pretty reliable measure of value created by the firm. After all, what are free cash flows? Well, they're the cash flows generated by their operations, right? Selling their good and their service. But then you take out any money reinvested in the business in the form of CapEx, because you need that to generate future profits. And also you take out any of the operating cash flows that we hold in order to improve our net working capital. What's left over is literally cash flows generated by our company that are free to be distributed to shareholders and creditors, whether management decides to do it or not. So for that reason, we think that free cash flows are just a much better measure and a much better reflection of value created by a company. What I want you to notice is, so I'm showing you the math here of the discounted cash flows model. What I want you to see is this is essentially the exact same math as the dividend discount model. The only thing we've done is, number one, we've replaced dividends with free cash flows to the firm, but the math is exactly the same for all the same reasons. And the only other tweak we have to make is this. If you just execute the dividend discount model, but replace dividends with free cash flows to the firm, you will have estimated what we refer to as the enterprise value. What we mean by that is the value of both equity and debt, because free cash flows are free to go to both shareholders and creditors. So if all you do is replace dividends with free cash flows, you get the value of both debt and equity. But what we want is the fundamental value of just the equity. So what we do is at the very end, we subtract off the current market value of debt. Why do we subtract off the current market value of debt? It's because this part right here, the part of the dividend discount model with simply free cash flows swapping out for dividends, that represents the present value of all of the equity and the debt. So then if you subtract the present value of all the debt, which is D0, what you're left with is just the present value of all of the equity. So that's the two tweaks. We just take the dividend discount model, we replace dividends with free cash flows to the firm, and then at the end we subtract out the present value of debt, and that leaves us with the market value, the present market value of equity. So let me give you an example of this, and I'm really just focusing on the math right now. So this is for Tootsie Roll, and here's what I'm doing. I'm doing a little bit of a shortcut, by the way. I should be clear here. So how would you forecast free cash flows to the firm? This is where you would have to leverage what we've learned previously in the semester, right? Percentage of sales forecasting to forecast income statements and balance sheets. From there, you could calculate free cash flows to the firm. Okay, I'm not going to do that for time purposes. I'm going to shortcut the math. Okay, so I'm going to execute the discounted cash flows model for Tootsie Roll. I'm going to begin by acknowledging that last year, their free cash flows to the firm were $62.2 million. Now, I'm going to shortcut the forecasting of free cash flows to the firm. Remember, the proper way to do this is to use the percentage of sales method to forecast these free cash flows to the firm for the first 7 years. I'm going to shortcut it. The way that I'm going to shortcut it is I'm going to assume a starting growth rate of 5% and a steady state growth rate of 3%, and I'm just going to monotonically ratchet down the growth rate in free cash flows to the firm. So beginning with 62.2 million and just growing it at these monotonically decreased growth rates, I get the free cash flows to the firm that look like this for the 7 years. I'm going to take the present value of each of those cash flows using our Keystone, Cornerstone, Searstone formula. And you can see me doing that right here. Free cash flow in the first period divided by 1 plus the discount rate, and I raise that to the first period. I do that for each of the free cash flows, and it gets me this. Next step is to take the free cash flow in the next period, the 8th period, the period after our final period. Take that next free cash flow and divide it by R minus G. So I'm going to take the free cash flow in the 8th period, divide it by the difference between 6.5% and 3%, and that's going to give me what I'm going to call the continuing value. So that's $2.4 billion. That represents the present value standing at the end of period T of all of the free cash flows in perpetuity after we hit steady state. But I also need to discount that back 7 years. So right here you can see me taking the continuing value, that's what I call it, dividing it by 1 plus the discount rate raised to the 7 years, and that gets me present value. Now I add up all the present values, and that gets me to the enterprise value. So that represents the value of equity and debt, $1.9 billion. The next step is to subtract out the value of debt right now. Most people just go to the balance sheet and they take the book value of long-term debt. I'm okay if you take the book value of all debt. Some people would say, no, I want market value. If you wanted to get market value, that's not a problem. You just go and find their bonds, and you use the market price of the bonds to figure out the market value of their bonds, and you use that. Whatever you use, you go and get the value of debt. Now we know Tootsie Roll has very little debt. So I subtract the value of their debt from our enterprise value, and that gets me a market value of equity. So that represents the market capitalization of the company. If you go to Finance Yahoo, type in Tootsie Roll, right here on the front, it's going to show you a market cap of $2.04 billion. That's what we've just calculated. We've calculated we get a market cap of 1.7 billion. So we're a little off, but those are the same numbers. Then you divide that market cap by the number of shares outstanding, which is easy to get if you just go to Key Statistics on Finance Yahoo, which is over here on the left. Then you can get the number of shares outstanding right here, which is 37.61 million. So I put that in for shares outstanding. I divide market cap by shares outstanding, and I get an intrinsic value of $46.50 per share, whereas the market value right now is $33.37. So for me, I'm stating that Tootsie Roll is a little bit undervalued by the market. I have Tootsie Roll at $46.50. The market has Tootsie Roll at only $33.37. So, okay, this is an example of the discounted cash flows model. What do we like about it? Well, like the dividend discount model, we love that it's based on very sound theory, but it also has an added advantage in the sense that we believe that the DCF model uses a better measure of cash flows, so it does a better job of answering this first question of what cash flows to use. There are, unfortunately, some downsides to this model, however, as well. First off, free cash flows to the firm are notoriously challenging to forecast. Secondly, projecting the steady state growth rate is somewhat challenging. And third, it's very sensitive to the inputs, especially the steady state growth rate. Let me try to show you what I mean. So I get an intrinsic value of $46.50. What if, however, I think the steady state growth rate is only going to be 2%? You can see that drops the intrinsic value by $10. So this model is very, very sensitive to that steady state growth rate. So because of that, because this model is very sensitive to the steady state growth rate, I want to take a digression and talk about that. So let's move forward and talk about estimating the steady state growth rate. And I want to begin with just basic economics 101. Abnormally high growth rates, or abnormally high rents, or abnormally high profits, these invite competition. If you're in an industry with a super high growth rate and high profits, high economic rents, that's going to invite competition. And when the competition enters, that's going to lower the profits, it's going to lower the growth, it's going to slow down the industry. Alternatively, if you're in an industry with abnormally low growth rates, this should lead to exit. So if profits are very low, then the entities in that space should realize that they could make more money and they could have faster growth if they were in another industry. So you should see exit occur in an industry with abnormally low growth rates. So, and if you start to get exit from the industry, that should actually increase the growth rates for everybody that's left. So this leads to an axiom. Firms should only ever expect average growth rates over the long run. So once a company hits steady state, it should not expect to be able to grow its free cash flows at anything higher than an average growth rate for the economy. Well, that begs the question, what gives us a good reading on average growth? This takes us back to an earlier discussion. I want you to remember what GDP is. GDP is the market value of all final goods and services produced in an economy during a period. Therefore, the delta in GDP is the average growth across all sectors of the economy. And if you think about that, that includes high growth sectors and that includes languishing, slowly dying sectors. So the delta in GDP is a nice, reasonable metric for average growth in your economy. Therefore, estimated delta, estimated growth in GDP seems to us to be a reasonable approximation of a steady state average growth rate. So if you could come up with some reasonable estimate of growth in GDP in the long run, that might be the best guess you could come up with for a reasonable steady state growth rate. So there's sort of two generally accepted ways of approaching this question of, well, what is the average delta in GDP? The first one is to just do a simple exponential growth model, and this just uses the basic time value of money formula. You remember from the time value of money conversation that the future value is just the present value times 1 plus the growth rate raised to however many periods there are. So we can use that to back into what the average growth rate is, right? If we just solve for R, then we can say, well, if we had a starting GDP number and an ending GDP number, then if we just divide those two and raise it to 1 over however many periods there are and subtract 1, then that gives us the average geometric growth rate, right? That's the EAR, the effective average rate. So this is very simple to do. Let me show you how to do this. So you can go to the Bureau of Economic Analysis and you can download gross domestic product right here. Just grab the Excel file. So I'm going to pull this up and make it so that we can manipulate it, and I'm just going to use annual data. So I'm going to get rid of the quarterly data. So here's the annual data. By the way, this is nominal GDP, this is real GDP. Maybe we'll do it for both of these. And so the first thing I'm going to do is I'm going to say, okay, I have a GDP in 1929. Maybe I should make this bigger. I have a GDP in 1929 and I have a GDP in 2015. How many growth periods does that represent? Well, we could calculate the growth each period, right? I could take this GDP, subtract out the previous GDP, and divide it by the previous GDP. So what does that say? From 1929 to 1930, GDP contracted by 12%. That doesn't surprise us. That's the Great Depression. So, okay, and we could see that's the GDP growth rate every year, and we might want to put a decimal or two on that just to give us more precision. So here's the thing I want you to notice. If I'm doing nominal GDP, so how many growth periods are there? So I'm just going to count the number of growth periods. And the number of growth periods is 86. So that's going to become the T in my equation. So I'm going to take the most recent GDP divided by 1929 GDP raised to the 1 over 86 and subtract 1. So let's do that. I'm going to take the most recent GDP in 2015. I'm going to divide it by the 1929 GDP. Put that inside of parentheses. And raise it to the 1 over 86. And then I subtract 1 from that. And I turn that into a percent. So that's an effective annual rate of 6.16%. Now we could do the same thing for real GDP. So again, we can come right here and just calculate the growth rates. Send that down the line. And again, I can do the count. It should be the exact same. So again, 86 growth periods. And I'm going to calculate the effective annual rate by taking the 2015 real GDP. And you might want to remind yourselves the difference between nominal and real. Remember that GDP can grow either because productivity is growing or because inflation is growing. Nominal GDP doesn't make a distinction. So nominal GDP is just growth in GDP, whether it's inflation or productivity. Real GDP strips out the effects of inflation, so these growth rates are solely a function of productivity increases. So I'm taking the 2015 real GDP, dividing it by the 1929 GDP. I'm raising that to the 1 over 86. And then I'm subtracting 1. And I'm going to format it the same way, and I get 3.24%. So that's one way to get an estimate of long-run average growth rate in GDP. Then you might ask me, well, okay, that's a big difference. Which one of those numbers might you use in your discounted cash flows model? So come back here. So what do I put in for G? Well, most economists would tell you, oh, well, you should just use real GDP. I actually believe you need to tell me how you're calculating your discount rate. If you're going to include inflation as a part of your discount rate, your R, then you should use nominal GDP. So if you're going to create a discount rate that captures inflation, you should use this. If, however, you're going to leave inflation out of your discount rate, then you should use real GDP. The logic behind that is this. If you assume, let's say you use real GDP as your steady state growth rate, but then you use a discount rate that actually is increased because you've included inflation. What you've done is you've forecasted cash flows that are not increasing as a result of inflation, and then you've discounted them and penalized them for the possibility of inflation. That doesn't make sense to me. Either you grow the cash flows using inflation and then discount them for inflation, or you don't grow the cash flows using inflation and you don't penalize them for inflation. So you just have to be consistent. Either you use nominal as your G and you increase your discount rate accordingly, or you use real GDP and you make sure that your discount rate doesn't include inflation. However, having said that, this is not a great method for estimating growth in GDP, and here's why. This method only uses data from the first and last GDP observations. What I'm trying to say is if you do a scatter plot, if you create a scatter plot of this data set, so what I mean by that is just put the year on the x-axis and nominal GDP on the y-axis, it looks like this. And so you can see it's got sort of an exponential growth rate going, which, by the way, sort of supports what we were saying earlier, that the rate of innovation seems to be increasing. We sort of see that play out in the GDP curve here. But again, this is nominal. But I want you to realize that when you're calculating the average growth rate, all you're really doing is calculating the slope of the line that connects 1929 and 2015. Those are the only two dots you're using. And I want you to see if you just connect the last dot and the first dot and take the slope of that line, that's very different than the slope of the line that you might get at other tangent points. So it's a really rough, noisy approximation of the average growth rate. It's really only the average growth rate between the last and the first dot. So there is another method for estimating growth in GDP, and I want to warn you, this is a much more advanced method. I would never test you on this. I just want to expose this to you to show you the more precise, better method that captures more of the data. In other words, this is a method for estimating the growth in GDP that lets all of these dots inform the average growth rate, not just the first and the last dot. So here is the method. Remember from algebra that the equation of a line is y equals mx plus b. Y is the dependent variable. X is the independent variable. M is a constant. It's a slope coefficient. B is also a constant. It's the y-intercept. Well, if we start with the equation that I just showed you, right, just the simple future value formula, but instead we're using GDP, what if we took the natural log of both sides? Okay, and I'm going to ask us to do a little bit of math here, but it shouldn't be too bad because I'll show you all of the rules that matter. So if we take the log of both sides, that's easy. But if you remember the properties of natural logs, if you have the log of x times y, that's the same as the log of x plus the log of y. So over here, if we have the log of GDP times 1 plus r raised to the capital T, that actually breaks down into the log of GDP at time 0 plus the log of 1 plus r raised to the t. But we also remember from properties of natural logarithms that the log of x raised to the y becomes y of ln of x. Using that property, we actually can pull this exponent down in front. So now what we have is that the natural log of GDP in any given year equals the natural log of GDP in the first year plus whatever the year is, the time indicator, times the natural log of 1 plus the growth rate. Notice that that's a linear relationship. We have an equation for a line up here. Let's decipher what represents y, m, x, and b. Well, the natural log of GDP in any given year would be the y variable. X would be the year, so that's the thing that's changing is the year, so that's x. The constant slope coefficient would be this natural log of 1 plus r, and by deduction that means that the y-intercept would be the natural log of the first year GDP. Well, we can use this linear relationship and regression to estimate the annual growth rate in GDP using all the data points. So I'm going to try to use color coding to help us keep it straight. So we know that y equals b plus xm, that's just the same thing as y equals mx plus b. I've just flipped it around a little bit. We just said that there's a linear relationship between GDP in any given period and the year. And the linear relationship is this, where the y variable is the natural log of GDP in any given year. The y-intercept is the natural log of GDP in the starting year. T, or the year, represents the x variable that's changing. And then the constant slope coefficient is the natural log of 1 plus the growth rate. So If each year we just record the year, that's the X variable, and each year we just record the natural log of GDP in that year, then we can estimate a regression. The natural log of GDP in any given year is a Y variable. The year represents the X variable. The slope, so then we're going to estimate that regression. So we're going to have a whole bunch of natural logs of GDP. We're going to have the corresponding year. We're going to estimate the regression. That's going to give us a y-intercept and a slope coefficient. That slope coefficient represents the natural log of 1 plus r. We can then solve for r. So we know that the slope, m, equals the natural log of 1 plus r. If we raise each side to the natural exponent, because you can do the same thing to both sides, and we also know through the properties of that natural exponent that e raised to the ln of x just equals x. So if we take each side and raise it and take e raised to each side, then we have on this side e raised to the ln of 1 plus r. But since e raised to the ln of x equals x, that just reduces to 1 plus r. We can then solve for r. r equals e raised to the slope coefficient minus 1. And that gives us a better estimate of the average growth rate in GDP because it uses all of the dots. So let me show you how to do this. So let me do this for nominal GDP. So what I'm going to do is I'm going to take the natural log, ln, of all of these GDPs. Okay? And I'm going to give it a little bit more precision. Now I'm going to go ahead and create a scatter plot for that just so we can see it. Okay, so here is a scatter plot. On the x-axis, I have the year. On the y-axis, I have the natural log of nominal GDP. Now what I'm going to do is I'm going to fit a line through it using regression. So I'm not going to just use the time value of money formula. I'm not just going to connect. Remember what we did before? We just connected the first and the last dot. Now I want to use all the dots. So remember what regression does. It fits a line through these dots that best fits the data by minimizing the squared vertical distance between the dots and the line. So let's go ahead and add a trend line. And I know that's hard to see, so let me try to make that a little bit bigger for us. Okay, so there is the trend line. And again, I want to emphasize that trend line is created by minimizing the squared vertical distance between all of the dots and the line. So this line is created by using data in all the dots, not just the first and the last dot. So then what we can do is we can actually, using this trend line, we can go ahead and see what the equation is for the trend line. So you can see here is our trend line. So there is y equals mx minus b or plus b. So what is our slope coefficient? Our slope coefficient is 0.0705. Okay, so let's do this. We want to get the estimated delta in GDP, and we know that our slope coefficient is 0.0705. So 0.0705. So we want to get the delta in GDP. And how are we going to get the delta in GDP? We're going to take e raised to the slope coefficient minus 1. So we just take exponent raised to the slope coefficient minus 1, and we're going to give that a little bit more precision. There's a big difference between estimating the growth in GDP using all the data points and just the first and the last data point. You might be interested to see what it looks like for real GDP, so let's do that real quickly as well. So I'm going to go ahead and calculate the natural log of each of the GDP numbers, the real GDP numbers. Now I'm going to create a scatter plot. Okay, so I've created the scatter plot using real GDP, and I've gone ahead and fit the line through it, and you can see that the slope coefficient is 0.0351. So we put 0.0351 in, and then we take e raised to the 0.0351, subtract 1. Give it a little bit more precision, and so we can see that the average long-run growth rate in real GDP using all data points is 3.57%. Okay, I want to reiterate, that's a very advanced technique for estimating the average long-run growth rate in GDP, but it is, we think, the best method for estimating the average long-run growth rate in GDP. So what would we do then? We would say, well, I'm either going to take 7.3% or 3.57%, and I'm going to use one of those as the G, the steady state growth rate, in my models. Which one am I going to use? Well, it doesn't matter as long as you also are consistent with your R. So if you use 7.3%, as your steady state growth rate, you better make sure that your discount rate also includes inflation. If you use 3.57% as your G, then you need to make sure that your discount rate does not include inflation, because you would be double penalizing in that case. What I mean by double penalizing is you would be penalizing the free cash flows by not growing them in inflation, and then you would penalize them for inflation by discounting them back using inflation. So just be consistent. Okay, so that's, again, a very sort of technical digression. I would never test you on this, but I figured that you do not want a watered-down experience, and so I just wanted to show you how most financial economists would recommend estimating a steady-state growth rate for your models based on GDP. The last thing I want to show you is what we call the valuation football field. So let's say that you've done several models. You've done a discounted cash flows model. You've done a dividend discount model. You've done a couple of method of comparables models. You've essentially done this Kcm Analytics. You've done a whole bunch of models, and now you've come up with your estimates. And so what if your estimates look like this? A method of comparables model using EPS, you get a range of 28 to 32. Method of comparables using sales, you get 27 to 33. Dividend discount model gives you 24 to 30. DCF gives you 29 to 37, and residual earnings model gives you 28 to 36. How do we take this then and triangulate a fundamental value? Well, we recommend mapping out what you could think of as the valuation football field. So it just looks something like this, right? Here is all of my ranges for my valuation models. And then what you look for is, where do they overlap? So you sort of draw that narrow band where all of the valuation models overlap. And you can see that what that suggests is your intrinsic value is somewhere between $29 and $30. And this is precisely how Kcm Analytics approaches it when they get their fair value estimate of $113.91. You should see that it's somewhere between all of these models right here. Now, a final word. If you do that, if you do the valuation football field, what you're saying is, I have no idea which of these models is the right model. You're sending the white flag up the pole. You're surrendering and saying, I just have no guess as to which of these models is good, bad, or ugly. That's fine. A lot of people do it that way. But I will tell you that I'm much more impressed with the analyst. And this is fine. I want to see the valuation football field. It's informative. But I'm much more impressed with the analyst who comes back to me and says, you know what, here's my football field, but I actually believe that this model or these two models are much more reliable. I feel much better about the inputs. They might make much more sense to me for these reasons. I have a lot more respect for the analyst that can take a strong statement and a strong stance about which one or two models they think are best, and then let's go with those models. And if we're not sure and we can't get comfortable, then we'll sort of revert back to the valuation football field. So then once you've done your valuation football field, or you've depicted your one or two models, now you've got your intrinsic value. The last step is to go and compare that to the prevailing market price. If your value is higher than the market price, that's a buy signal. If your value is lower than the market price, that's a sell signal. And if your value is approximately equal to the market price, then that's a hold signal. All right, there's a lot more we could talk about, but I think I've probably talked you into a numb stupor at this point already. So let's go ahead and close right there.